All right, today we're going to take a look at monetary policy. This is one of the two policies used by governments to influence the business cycle and control the macroeconomy with it. So let's take a look at what this means. And the first thing we have to do is kind of keep in mind that monetary policy is using the money market to have an influence on interest rates to stimulate or to slow down the economy. So the first thing we want to do is start with our graph of the money market. And I'd like to point out here we've got that vertical money supply line and the question of why is it vertical, all right? Well, the real answer to this is that the money supply is controlled by the Federal Reserve and is not, the Federal Reserve's decisions about the money supply are not dependent upon interest rates. That is, that no matter what the interest rate is, the Federal Reserve has an established amount of money that is in the system. They can choose to increase or decrease the amount of money in the system, but it's not going to be as a result of the nominal interest rate. And of course, we can see how they would influence the interest rate by they can lower the nominal interest rate, according to this model at least, by one of two things. Well, actually, the Fed can only use one tool to lower the interest rate. That is, if they increase the money supply, we can notice that the interest rate is now at a lower outcome. The other thing I could point out, though, is that in addition to increasing the money supply, if, for example, the money demand were to decrease, that would also result in a lower interest rate. So changes in the nominal interest are either going to be a result of a shift in money supply or a shift in money demand. The Federal Reserve is in charge of the money supply, and therefore that's what they are going to adjust to make changes to the interest rate. So what are the goals of the Federal Reserve in this? Well, this is actually mandated by law. There's something that's called the dual mandate. The federal government has said that the Federal Reserve, has to pursue a policy that is going to achieve both low inflation and low unemployment. And if you can remember from our examination of the business cycle graph, that inflation and unemployment are generally inversely related. Now, a little bit later, we're going to see the Phillips curve that is going to more completely describe that relationship. But it's a difficult job to do, to have low inflation and low unemployment at the same time, historically. We can see that right now, though, this is our current situation where our inflation is very low and our unemployment is also exceptionally low. Well, that's changed very recently, but as of about a month ago, our unemployment rate was very low. Below, in fact, UN, which is, of course, the natural rate of unemployment. In addition to the dual mandate, the Federal Reserve also ascribes to the Humphrey-Hawkins Full Employment Act that also says that economic growth should be a goal for the macroeconomy. So really there are three goals the Federal Reserve has: low inflation, low unemployment, and economic growth. So the Federal Reserve is in charge of monetary policy. And basically, there's no surprise that monetary policy is controlled by changing the money supply, which we have talked about as M1, the most liquid form of money, including currency, checking accounts, and to a much lesser extent, traveler's checks. And basically, what we're going to do today is take a look at the three tools that the Federal Reserve has at its disposal to alter that monetary supply: the reserve requirement, the discount rate, and open market operations. Let's start with the reserve requirement. You'll remember that the banking system in the United States is predicated on fractional reserve banking, which means that banks hold on to a portion of deposits and loan out the rest. And this is the way banks have operated since banks started to exist, essentially. The reserve ratio that we see identified here is determined by the Federal Reserve for all of the participating banks in the United States. So if there's a reserve ratio of, say, 10%, just as a reminder, that means that 10% of deposits have to be held and cannot be loaned out. So if you had a deposit of $1,000 at a 10% reserve requirement, $100 would be required reserves, excess reserves would be $900. The bank would be able to loan out all $900 of that, and that $900, once loaned out, would end up as a deposit in another bank, and the whole process kind of continues with this. And that process is descriptive of the money multiplier, which I hope that you remember already. That essentially we can figure out what's the total amount of money that can exist in the system given an initial deposit and a reserve requirement ratio. And basically, if you divide 1 by the reserve requirement times the initial deposit, you're going to get that. So in our little table over here that we have, if our initial deposit is 1,000 and our reserve requirement is 10%, well, 1 over 10% is equal to 10 times the initial deposit of 1,000 is going to be equal to $1,000. $10,000 of money in the economic system. And we have to be careful. There are questions on the AP that will ask you about a change in the money supply versus the size of the money supply. So, for example, if you had a $1,000 sort of secret stash in your bedroom that you deposited into a bank, that $1,000 isn't new money that you deposit. But the $9,000 of loans that come about as a result of that would be new money. So the change in the money supply would be $9,000 in that situation. Just to kind of tie this in to how does this connect to monetary policy? Well, the Federal Reserve can either increase the reserve requirement or decrease the reserve requirement to change the total amount of money in the system. So if they increase the reserve requirement, if they change this 10% reserve ratio to, say, 20%, banks are going to have to hold on to twice as much, which means that they're going to be able to loan out considerably less money. And it's not just that the initial loan is lower, but because each successive bank is going to have to hold on to more money, all of the loans are going to be less. So we can kind of see in that situation that if we just were to change this 10% to 20%, well, 1 over 0.2 is equal to a multiplier of 5 times that initial deposit of 1,000 equals $5,000 that's in the system. So we can see that this is a very, very powerful tool, changing that reserve requirement ratio. It's so powerful that the Federal Reserve very rarely uses it, but it is one of the tools that's at their disposal. Something that you're going to see a lot more frequently, though, is a change in the discount rate. The discount rate is one of the tools that the Federal Reserve uses in its capacity as a bank for banks. Remember that the Federal Reserve holds on to deposits for banks and also can act as a lender of last resort. That is to say that if a bank needs money and they need to borrow money, if they cannot find it from another bank, that the Federal Reserve will loan them money. That doesn't come free, though. So discount rate is basically, this is the interest rate charged by the Federal Reserve to banks that are borrowing from the Federal Reserve. So this is an interest rate from the Federal Reserve to banks. We have to distinguish that from the federal funds rate. The federal funds rate is a bank-to-bank rate. And so changes in the discount rate will have an influence on the federal funds rate generally, but don't always have to. But if you want to think about the impact of a change in the discount rate on the money supply, well, if there were an increase in the discount rate, it would make it harder for banks to borrow money. If banks don't borrow as much money, they're not going to be able to loan as much money out, and that money supply is going to shift to the left. and decrease decrease the money supply as a result of an increase in the discount rate. Obviously, a decrease in the discount rate is going to have the opposite effect. It's making it easier for money to be loaned out. More loans will be made. More money will be in the system. The third and most powerful tool, this really is the one that is used most frequently, is the most often used, is something that we really need to understand, and that is open market operations. Essentially, the Federal Reserve has the authority to buy or sell U.S. Treasury notes on the market. Well, what does that mean? Well, that means that the Federal Reserve is the agency that's responsible for selling promissory notes of the U.S. government. So essentially, this is an IOU. The federal government saying that we are going to pay back this $10,000 Treasury note at some future date. And so the Federal Reserve has the ability to either buy or sell these notes on the open market. So, for example, if the Federal Reserve were to buy a Treasury note from a bank, a $10,000 Treasury note, well, that means that coming out of the bank's balance sheet is going to be this asset that they had, this IOU, a promise from the government for $10,000 at some point in the future. If the Federal Reserve buys that bond now, that isn't, there's going to be money that's put into the account of these banks, and that money then is going to be new money in the system, right? Because the bond couldn't be spent. The bond isn't part of M1. It's not money at all. And so this new money is put into the system in exchange for the bond. This new money is not a deposit, and therefore it is not subject to the reserve requirement that we talked about earlier. Therefore, all of this all goes into excess reserves, and all of that money could be loaned out. So the opposite can be examined as well. That selling a bond, if the Federal Reserve sells a bond to a bank, the bank can use assets that it has to take on this bond, and that's going to decrease the amount of excess reserves that the bank has, and that's going to decrease the money supply. So one way that I think is easy to remember that is that if the Federal Reserve is buying bonds, the money supply gets bigger. And if the Federal Reserve is selling bonds, the money supply gets smaller. So we can kind of take a look then at what could happen to change this money supply. So expansionary money supply, just remember, if this is the money supply, expansionary money supply would be shifting it to the left. And that can be achieved by either using any of the three tools, I should say. But to be clear, if you're expanding the money supply, it's getting bigger. So for open market operations, the Fed could buy bonds. For reserve requirement, the Federal Reserve could lower the reserve requirement. And for discount rate, again, the Federal Reserve could lower the discount rate. All three of those policies are expansionary or loose money policies, and that's going to have the impact of increasing the money supply, shifting it to the right. On the other hand, you could pursue a contractionary or tight money policy, and that is seeking to move the money supply in the opposite direction. That if you wanted to decrease the money supply, you could shift it to the left. That's a contractionary monetary policy. And this can be achieved in open market operations if the Fed sells the bond, if they increase the discount or the reserve requirement, or if they increase the discount rate. Any combination of these three is going to have an impact of decreasing the money supply, shifting it to the left, and that's of course going to raise interest rates. So why do we care about this? And here's kind of the payoff for all of this. And we'll spend some more time talking about this in the future, but changes of monetary policy are going to have an impact on the macroeconomy, that is GDP. And this is the equation that's going to help you to prove this. This is called the exchange equation. And the exchange equation is simply M times V equals P times Q. So let's talk about what these mean and how this is going to help us to understand this. So let's talk about the right side of the equation first. Let's talk about P times Q. This P is referring to the price level, right? This is basically the prices of all goods and services, and Q is going to be the quantity of goods and services that are produced. And that's essentially the output in the economy. So if you take the prices of all goods in our economy times the quantity of all goods in our economy, you're going to get a dollar value for the economic output of our economy, which we've previously described as GDP. That kind of makes sense. If you take all of the money that if you take all of the prices in society times all of the goods in society, you're going to get the total value of those goods and services. Well, let's talk about the other side of the equation now in M times V. So M is simply going to be M1. This is our money supply. This is the amount of money that we have in the system. And V is an interesting concept. V is considered to be the velocity of money. And the velocity of money, this is an important vocabulary term. The velocity of money is how frequently money is spent in a given year. And if you have the amount of money that's available and the number of times that it's spent in a given year, well, if you multiply those, you're going to come up with this equation. The total amount of money times the number of times it's spent has to balance off with the total GDP. And so this is the exchange equation. And so you can see then that if you were to pursue an expansionary monetary policy, if you increase the money supply, what impact is that going to have? Well, a lot of times economists believe that the velocity of money, how frequently money is spent in a given year, is constant. And so that a change in money supply is going to have a change in GDP, and a direct change in it, in fact. And that an expansionary monetary policy is therefore going to have the impact of increasing the GDP. Here's the interesting question, though. What's going to happen to that change? Is this a real change in GDP, or is this a nominal change in GDP? Just remember that nominal GDP is inflated value, current value of money. And obviously, if you're going to increase the amount of money that's in the system, that's going to decrease the purchasing power of money in the system. And if you can guess where we're going with this, that would result in a nominal change in GDP, not a real change. We're going to have to explore that a little bit later, but I hope that this helps you to understand a little bit about the three tools of the Federal Reserve.